principles, mechanisms, and future prospects. Introduction. Islamic finance is an increasingly popular sector within the global financial industry, operating in accordance with Islamic principles and guidelines. If you are curious about how Islamic finance works, this article will provide you with a comprehensive understanding of its principles, mechanisms, and future prospects. Principles of Islamic finance. Understanding the principles of Islamic finance is crucial to comprehending its functioning. Prohibition of Riba. Interest. Islamic finance strictly prohibits the charging or paying of interest, as it is considered exploitative and promotes inequality. Instead, profit-sharing and risk-sharing arrangements are utilized. Prohibition of Gharar, uncertainty. Transactions involving excessive uncertainty or ambiguity are prohibited in Islamic finance. Contracts must be transparent, and all parties should have a clear understanding of the terms and conditions. Prohibition of Haram, forbidden activities. Islamic finance strictly prohibits investments in industries deemed unethical or forbidden in Islam, such as gambling, alcohol, pork, and tobacco. Promotion of ethical and socially responsible investments. Islamic finance encourages investments that benefit society and avoid harm, such as those promoting sustainable development, social welfare, and environmental sustainability. Key mechanisms of Islamic finance. To understand how Islamic finance works, it is essential to familiarize yourself with its key mechanisms. Mudaraba, profit-sharing partnership. Mudaraba is a partnership agreement between an entrepreneur, Mudarib, and an investor, Rab al-Mal. The financier provides the investment, while the entrepreneur manages the business. Profits are shared based on pre-agreed ratios, while losses are borne solely by the investor. Musharaka, joint venture. Musharaka involves two or more parties pooling their capital to engage in a business venture. Profits and losses are shared in proportion to the capital contribution, and each party has the right to participate in the management of the business. Murabaha, cost-plus financing. Murabaha is a prevalent financing structure used in Islamic banking. It involves the bank purchasing an asset requested by the customer and then selling it to them at a higher price, payable in installments. This arrangement allows the customer to acquire the asset without paying interest. Ijara. Leasing. Ijara is a leasing arrangement where the lessor purchases an asset and leases it to the lessee for a specified period. The lessee pays periodic rentals for the use of the asset, and ownership may or may not be transferred at the end of the lease term. Sukuk, Islamic bonds. Sukuk are financial instruments similar to conventional bonds, but structured to comply with Sharia principles. Instead of earning interest, Sukuk holders receive a share of the profits generated by the underlying asset or project. Regulatory framework and institutions. To ensure compliance with Islamic principles, various regulatory bodies and institutions oversee the Islamic finance sector. These entities provide oversight, standardization, and certification. Prominent regulatory bodies include the Islamic Financial Services Board, IFSB, and the Accounting and Auditing Organization for Islamic Financial Institutions, AAOIFI. Islamic financial institutions, such as Islamic banks, Takaful, Islamic insurance companies, and investment funds, operate under the guidance of these regulatory bodies. They offer a wide range of financial products and services tailored to meet the needs of individuals and businesses seeking Sharia-compliant alternatives. Global growth and future prospects. Islamic finance has experienced significant growth, with Islamic banking assets surpassing $2.88 trillion globally. Its popularity has expanded beyond traditional Islamic finance hubs, gaining traction in both Muslim-majority and non-Muslim-majority countries. Governments, corporations, and individuals are recognizing the benefits of ethical finance and the potential for sustainable growth. Looking ahead, technological advancements, such as blockchain and fintech, are expected to enhance the efficiency and accessibility of Islamic finance. The industry is also exploring new frontiers, including green and sustainable finance, Islamic microfinance, and fintech-driven Islamic peer-to-peer lending. Understanding how Islamic finance works entails grasping its underlying principles, key mechanisms, and regulatory framework. Islamic finance offers an alternative financial system that promotes ethical practices, risk-sharing, and responsible investments. With its growing global presence and potential for future innovation, Islamic finance is poised to contribute to a more inclusive and sustainable financial landscape.